Early days of private equity, you heard a lot of talk about LBOs, where companies are acquired and then divisions sold or restructured, and basically returns generated through, quote, financial engineering. To what degree do y'all rely on financial engineering versus getting your returns through operations?
We are not financial engineers. York, more broadly, both on the hedge fund side and on the private equity side, is very conservative when it comes to leverage. I would say across the private equity portfolio, we're probably 30% debt, 70% equity, and I'd say the inverse is true for a lot of our peers. And there's a couple of reasons for that. I think one, we all want to be able to sleep at night. We don't want to have to worry that some hiccup in the economy or hiccup in the specific market the company's in, or you lose one of your big customers and you worry about losing your entire company. We would rather grow the value of the business and generate our return through operating it more efficiently. And our mindset is, let's go in, we have a 12 to 24 month plan. If it works, we'll always use debt as an exit. And we can always refinance the business 2 years later when we've grown it to a point where we'd always sort of set out to do. And we feel much better that it's operating well enough to where we can take out some conservative leverage and more use it as an exit more than as a way for us to be able to enter the company.
We're the same way, and we certainly have generated some returns via leverage. We use leverage on all of our deals. It's probably closer to 50-50, 50% debt, 50% equity. But the investments that have really worked out well for us are the ones where we've generated growth. And that's really backing a management team and working with a management team on a strategic plan to grow the business. And those are the ones that have really worked out well. So some returns via leverage, but the majority of them that do really well are through growth.